Alright, if you're watching this right now, pause whatever chart you're staring at and stay with me, because something just snapped in the silver market. I'm talking about a parabolic move that took months to build, and then unwound in hours. On January 30th, silver ripped straight through the $120 level to the downside, and once that line went, it wasn't a gentle pullback. It was aggressive, fast, and mechanical. Billions in paper value vanished in a shockingly short window. And here's the key point most people are missing. The real trigger wasn't panic in the physical market. It was positioning stress colliding with a suddenly hostile macro backdrop. I'm going to walk you through what just happened, why it matters right now, and how you can spot this setup before it hits again. Before I explain what caused this move, let me teach you something most people never fully internalize about parabolic markets. When price goes vertical, it feels strong, it feels safe, it feels almost inevitable. You start hearing that this time is different. Everyone's talking about new paradigms. Everyone's got a price target that sounds crazy, but somehow feels reasonable. But here's the thing. A parabolic move isn't strength in the traditional sense. It's pressure building in a narrow pipe. Leverage stacks up. Stops creep closer. Everyone's on the same side of the boat. Think of it like traffic funneling into a single lane at high speed. It works, it flows, until it doesn't. And when something forces that lane to close, even briefly, the unwind is violent. That's not emotion, that's structure. And silver had been building that structure for weeks. Every day that price went higher without a meaningful pullback, more leverage entered the system. More people convinced themselves the move would continue forever. More stop losses clustered at the same technical levels. That's the setup. And if you've been following markets long enough, you know that setup always resolves the same way. So what does that tell us? It tells us that when you see parabolic price action, your job isn't to chase it blindly. Your job is to watch for the first sign that structure is cracking, because once it cracks, it doesn't crack slowly. If this is making sense so far, drop a comment and let me know where you were positioned when this happened. I want to hear your experience. Now here's what's actually happening under the hood. Let me break down the sequence. First, you had a sharp resurgence in the US dollar alongside rising treasury yields. That combination matters because it tightens financial conditions in real time. A stronger dollar raises the effective cost of holding dollar-priced assets like silver. If you're holding silver and the dollar strengthens, you're effectively losing purchasing power in other currencies. And higher yields? They raise the opportunity cost of holding non-yielding metals. Why hold silver at 0% when you can get 4 or 5% risk-free in treasuries? On their own, those moves don't always crash silver. We've seen silver grind higher even when the dollar was firm. But this time, they hit a market already stretched to the extreme. That's the primary driver. The macro backdrop shifted from neutral to hostile right when positioning was at its most fragile. Second comes the confirmation. Once silver failed to hold $120, which had become a psychological and technical anchor, stop losses started triggering automatically, not humans clicking buttons. Algorithms and risk systems doing exactly what they're programmed to do. That selling pushed price lower, which triggered more stops, which forced margin calls on leveraged futures positions. And here's where it gets mechanical. When you're running leverage in futures markets, your broker doesn't care about your thesis. They care about margin. If your position drops below the maintenance margin threshold, you get a call. You either add cash immediately, or they liquidate your position. And when hundreds or thousands of traders get that same call at the same time, liquidity thins almost instantly. When liquidity disappears, small orders move price a lot. A sell order that would normally move price a few cents can suddenly drop it $1. That's when an orderly pullback turns into a forced selling cascade. And here's what's wild about this. None of that requires a collapse in physical demand. Coins didn't suddenly become unwanted. Industrial users didn't disappear overnight. The mints are still selling. The fabricators are still buying. This was paper positioning unwinding fast. The futures market, the options market, the ETFs, all of that leverage and synthetic exposure had to be repriced in real time. But here's the part that should make you nervous if you weren't watching closely. When momentum flips this decisively after a parabolic run, it tells you how crowded the trade really was. Everyone thought they were early. Everyone thought they could exit calmly if things turned. The market reminded them they couldn't. The door out of a crowded trade is always smaller than the door in. This is the exact same playbook we've seen before. Go back to silver in 2011. We had a similar setup. Price ran from around $18 in late 2010 to nearly $50 by April 2011. Everyone was convinced silver was going to $100. The narrative was bulletproof: money printing, inflation fears, safe haven demand. And then what happened? A macro shift, some technical selling, and the whole thing unwound. Silver lost about 30% in a matter of days. It wasn't because the fundamental thesis died overnight. It was because the trade got too crowded and leverage got too high. Go back to oil in 2008. Crude ran to $147 a barrel in July. Everyone said we were running out of oil. Peak oil was the narrative. Demand from China was insatiable. And then the financial crisis hit, the dollar strengthened, and crude collapsed to $30 within months. Different asset, same pattern. Parabolic move, crowded positioning, macro shift, violent unwind. Go back to crypto in 2021. Bitcoin hit nearly $69,000 in November. Institutions were buying, retail was euphoric, every dip got bought immediately. And then what? The Fed pivoted hawkish, yields started rising, risk appetite dried up, and Bitcoin lost more than 70% over the next year. Every time this has happened, the first move down feels shocking. It feels unfair. It feels manipulated. But when you zoom out, you see the same sequence repeating. Markets don't collapse randomly. They fail at stress points. And $120 was a stress point for silver. The larger story is that markets respect structure more than narrative. You can have the best fundamental thesis in the world, but if positioning gets too stretched and macro conditions shift, price has to adjust. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be manipulation? Could this be a fake breakdown engineered by big players before the next leg higher? Could we see silver back at $140 in 2 weeks? Let me be honest. Markets can overshoot both ways. Sharp sell-offs can reverse just as quickly as they develop. We've seen V-shaped recoveries before. And yes, there are big players in every market. But blaming manipulation misses the lesson. It doesn't actually matter whether someone somewhere wanted this to happen. The mechanics are what matter. Leverage, stops, liquidity, and macro conditions created the environment where this could happen. Focus on what you can control. Read positioning. Respect momentum shifts. Don't anchor to one price level as destiny. Whether it's manipulation or market structure, your job is the same. Manage risk, watch the data, and don't get emotionally attached to a number. There are probably 3 types of people watching this right now. First, there's you if you rode silver up and you're feeling shaken right now. Maybe you bought in the 90s, watched it run to $130, and now you're sitting on gains that just got cut in half. That's normal. That emotional whipsaw is part of trading parabolic moves. Your job now isn't revenge trading. It's reassessing risk. Ask yourself how much of your thesis depended on price only going up. If your thesis was purely momentum-based, this changes things. If your thesis is rooted in long-term fundamentals, physical demand, monetary dynamics, then maybe this is just noise. But be honest with yourself about whether you were trading or investing, because the strategy for each is different. Second, there's you if you missed the rally and feel tempted to cheer the drop. Maybe you were waiting for a pullback that never came, and now you're thinking this is your chance. Careful. Sharp sell-offs are not automatically safe entry points. Just because something dropped 20% doesn't mean it won't drop another 20%. Let the dust settle. Watch for stabilization. Watch for volume to dry up on the downside. Don't catch a falling knife just because you feel like you deserve a chance after missing the move up. The market doesn't owe you anything. Third, there's you if you're long-term bullish on silver's fundamentals and you're trying to figure out if this changes the big picture. Maybe you stack physical. Maybe you believe in the monetary reset thesis, the industrial demand story, the supply constraints. That view may still be valid. I'm not here to tell you it's wrong, but even strong themes breathe. Even secular bull markets have corrections. The universal principle for all of you is this: separate structural moves from narrative emotion. What just happened was structural. It was mechanical. It was about positioning and liquidity, not about whether silver has value or whether the thesis is dead. So here's what I want you to answer in the comments. Which one of those describes you? And what's your plan from here? I'm genuinely curious how you're processing this. Here's where I stand. I'm not panicking and I'm not blindly buying. I'm watching. Let me tell you what I'm personally watching. First, I'm watching how silver behaves around former support turned resistance. If price tries to rally back toward $120 and gets rejected hard, that tells me sellers are still in control. If it grinds back above $120 and holds, that's a different story. It means the forced selling might be done and buyers are willing to step back in. Second, I'm watching the dollar and yields closely. If the dollar keeps climbing and yields keep rising, this pressure isn't done. The macro headwind is still there. But if the dollar rolls over or if yields start to stabilize, that removes one of the primary drivers of this sell-off. Third, I'm monitoring liquidity conditions, especially in the futures markets. I want to see signs that forced selling has run its course. When you see volume spike on the downside and then dry up, that's often a sign that the sellers are exhausted. When you see price stabilize even as bad news continues, that's another clue. Based on my analysis, this move was mechanical, not random. It was structural, not emotional. The fundamentals didn't vanish overnight. Industrial demand for silver is still growing. Central banks are still holding massive balance sheets. The supply side still has constraints. Those things haven't changed. What changed was the price structure and the positioning environment. And when those things get too stretched, they have to reset. If history rhymes and silver finds support in the low 100s or even the high 90s, the move that follows could be significant, but only if the macro backdrop cooperates. I'm not making a prediction. I'm telling you what I'm watching and how I'm thinking about it. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the charts. Look at the volume. Watch the macro data. Don't take anyone's word for it, including mine. If you made it this far, you're the type of person who thinks critically and doesn't just follow the crowd. That mentality will serve you well. Share this with someone who needs to understand what just happened. Subscribe if you want more breakdowns like this. And stay ahead of the noise. Think critically, verify the data, and make your own decisions. Stay sharp out there. All right, if you're here, you already feel it. Something big just snapped in silver, and you don't want the headline version, you want the real-time breakdown. So hit that like button, stay with me for a few minutes, and let me show you what just happened, because this wasn't a slow bleed. This was violent. Silver ripped through the $120 level like it wasn't even there, and tens of billions in paper value vanished in a shockingly tight window. And here's the part most people are missing right now. The real trigger isn't some sudden collapse in physical demand. This was a positioning event, a mechanical event. And if you understand this pattern, you'll see it coming next time, instead of reacting after the damage is done. Before I explain what caused this move, let me teach you something most people never really internalize about modern markets. Prices don't just move because of news, they move because of leverage. Think of the market like a crowded theater where half the audience is standing on chairs. Everything feels stable until someone yells, "Fire!" And suddenly, it's not about fundamentals anymore. It's about exits. When silver went parabolic into 120, it wasn't just investors buying bars. It was futures traders, options traders, funds leaning hard into momentum. And when leverage builds up like that, price becomes fragile. It looks strong, but it's brittle underneath. That's what you need to recognize going forward. Now here's what's actually happening under the hood. The primary driver was the sudden resurgence in the US dollar paired with rising yields. That combination is kryptonite for leveraged commodity trades. When yields rise, holding leveraged long positions gets more expensive. When the dollar spikes, dollar-priced assets feel immediate pressure. On its own, that's manageable. But here's where it snowballed. Silver had just completed a textbook parabolic run. That means stops were stacked, margin was thin, and once $120 failed, those stops didn't trigger one by one, they triggered together. So when price slipped, forced selling kicked in. Margin calls followed, liquidity thinned fast, and that's how an orderly pullback turns into a waterfall. Here's what's wild about this. The speed of the drop tells you everything. This wasn't long-term holders panicking. This was paper exposure being unwound at machine speed. Algorithms hit sell signals. Funds cut risk simultaneously. And because liquidity vanished in that window, every sell order pushed price further than it should have. So when you ask yourself why it felt so sudden, so sharp, so aggressive, that's why. And here's the part that should make you nervous if you're not watching carefully. When momentum flips like this, it doesn't care about your conviction. It only cares about positioning. Now, zoom out with me for a second, because this is not new. This is the exact same playbook we've seen before. In 2011, silver's blow-off top didn't end because demand disappeared overnight. It ended because leverage broke. In 2020, when gold and silver briefly crashed during the liquidity crisis, it wasn't fundamentals collapsing, it was forced selling. Every time you see extreme upside acceleration followed by a key level break, the unwind is violent. When you look at the pattern across cycles, the trigger changes, but the mechanics don't. The larger story is always leverage meeting a macro shift. Now let me be skeptical for a moment, because I know what some of you are thinking. Could this just be manipulation? Could this be a coordinated smash? Let me be honest with you. Markets don't need conspiracy theories when structure alone can explain the move. Big players didn't have to decide to crash silver. The setup did it for them, and focusing on blame doesn't help you trade or invest better. What helps is understanding where risk builds and how it releases. Focus on what you can control. Your exposure, your leverage, your time horizon. There are probably 3 types of people watching this right now. First, there's you if you rode silver up and you're feeling that pit in your stomach. That's normal. For you, the lesson isn't panic, it's position sizing. If a move like this can shake you emotionally, the position was too big. Second, there's you if you missed the rally and you're wondering if this is the end. For you, patience matters. These resets often create opportunity, but only after volatility settles. Third, there's you if you don't even trade silver, but you're watching this as a signal. And you should be. Because when leverage trades unwind, it often tells you something about broader financial conditions tightening. Here's where I stand. I'm not bearish on silver long term, and I'm not blindly bullish either. I'm watching 3 things closely. First, I'm watching whether yields continue climbing or stabilize. Second, I'm watching the dollar. Does this strength persist or fade? Third, I'm watching how silver behaves on the next bounce. Does volume confirm or does it stall? This move was mechanical, not emotional. The fundamentals didn't vanish overnight. If history rhymes, this was a reset, not a death sentence. Stay sharp out there. Think critically, verify what you hear, and make decisions that put you ahead of the crowd, not chasing it.